So thank you for joining us today. My name is Valerie Brown with United Policyholder, and our workshop today is on taxing matters. We're going to give you a second here to select your language. So on the bottom of the screen here, there's an interpretation globe. You're going to select English or Spanish. We're recording in both languages. So give you a second to make that selection. And this is what it looks like precisely. So is everyone hooked up now? Ignore that where it says Q&A. We have a chat where we'll put links for you, but you will not be able to chat today. All right. Marina, I'll turn it over to you. Thank you so much, Marina. All right, and just a quick little bit of housekeeping here. If you'd like to follow the slide deck tonight, we have it posted on our site here. Just go here under the event for this and you'll see it right here where it's circled. In that way, you've got it for reference. So to get us started, just a little bit about United Policyholders. We're a national nonprofit, been in existence 30 years. We serve as a trusted information resource and respected voice for insurance consumers in all 50 states. We're not for profit, we're not for sale, we're funded entirely by donations and grants. We have our team up, so our professional staff of about 15 people in the San Francisco office and other areas, government and nonprofit partners, and then our volunteers. So we have our fired up survivors who are previous catastrophic loss survivors who are paying it forward, and then our consumer focused professionals like John and Corey who are joining us today. So we have 3 programs, our Roadmap to Recovery. That's what this program is about. This is where we're helping you through getting through the recovery process after a catastrophic loss. We take those lessons learned from the Roadmap to Recovery program, roll that into our Roadmap to Preparedness program to help people reduce risk and be better protected for future disasters and adversity. And then our 3rd program feeds into the circle here. It's our Advocacy and Actions, where we're fighting for those pain points we identify in the Roadmap to Recovery and Preparedness to help protect insurance consumers' rights and add more protections. Just really quickly wanted to show you this is our California library. If you're new to our workshops, this is information for you for California 2020, California 2021. For the Marshall Fire, this is your library as well. I'm going to stop for a second, and Eva, can you please confirm that you are able to record? Eva, Carolyn, can you confirm that you're able to record? All right, thank you. Just wanted to catch that before we started. I'm going to take a deep breath. I'm going to slow myself down. Sorry about that, Marina. So fine print, this workshop is intended to be general guidance only. We are not providing legal or professional advice. We don't endorse or warrant any of the sponsors listed at our website or speakers at our workshop. These are our speakers today are volunteering their time as educators. They are not your personal CPA. They are here just sharing what they know to help you understand this process. So presenting today, myself, Valerie Brown, I'm the Senior Program Officer for United Policyholders. John Trapani is a CPA in the Thousand Oaks area of California. And Corey Parnell. And Corey, I'm going to butcher the name. I'll let you introduce your firm. I'm really bad at that, sorry.
Yep, Bokerman, Grafstrom, and Mayer.
Thank you. This is a little about me. We're going to skip me. John, he's licensed in California and Colorado. He's a disaster survivor, 28 years of disaster tax reporting. He also educates fellow professionals, and this is his contact information. And Corey is the Chief Executive Officer of BGM CPAs. I'm going to cheat again there. He's been serving clients for more than 35 years, and this is their contact information. And John, I'll let you go back and just introduce yourself briefly, and then Corey, I'll let you just have a minute to introduce yourself to the group.
Good afternoon, everybody. And well, I think Valerie did a good job there in terms of telling you the important things about myself. I actually got into this area because of my own experience experiencing the 1994 Northridge earthquake. So we just passed 28 years for that a couple of weeks ago. And so it was both professional and personal. And as a result, it got my attention, and it's kept my attention for the last 28 years. And I've been working with people, various fires and floods and stuff, such as these situations for all this time. So I'm always available to talk to people, and look forward to having a good session today. Corey?
Yeah, again, my name is Corey Purnell, and I'm with BGM. And how we got this opportunity to participate in this is through my partner, Jim Marty, who's in Longmont, Colorado. But we have a variety of clients as well as friends that have been affected by the fire in Boulder. So when Valerie approached us about participating, we just absolutely said yes. So look forward to the presentation and eventually, hopefully, meeting some of you.
Thank you both for joining us. I know it's a busy time in tax season, which is why we were trying to get this early enough that we could ease people's minds a bit. One of the tips I wanted to remind people, we mentioned this in a lot of our workshops, is you want to, keeping your paperwork organized is the key to getting more money. So keeping that claims recovery journal, saving receipts, these are some tips that we want to share to help you keep yourself straight. And these things are very important for what we're going to talk about, especially, I'm sorry, I'm clicking too far. That tracking insurance accounting spreadsheet at the bottom, that last bullet there, we actually had a CPA from the Woolsey fire create that for us because it fed into the information he needed to know when he was looking at how taxes impacted his how his insurance impacted his tax situation. So the goal of today's workshop is to help you understand the tax rules and options for disaster impacted households and make good financial decisions. So we're going to talk about when to file, timelines for reporting, how disaster declarations impact tax matters, the difference between a casualty loss and involuntary conversion gain, and why you might need help. And so here's the rundown of the full topic list. And we're going to go right into it with general tax matters. So I'm going to touch on this one briefly. For if you're in California, Prop 19 was enacted via a 2020 ballot measure. And this allowed homeowners who are over 55, if you're disabled or you're a victim of a wildfire or natural disaster, you can transfer your property tax base of your existing home to a new home without a price restriction. Prior to that ballot measure, which took effect in April 1 of 2021, a few counties had adopted that to help people when they bought a replacement home, but it was not uniform. And so that just passed last year. And then Corey, I'm going to let you talk about some of these and just tell me next slide when you're ready.
Yeah, I think John was going to cover this.
Oh, this is John, sorry.
Oh,
I'm out of order here, sorry. John, these are some of the common
We're all
tax
good.
questions, yeah. So, and I know I'm just gonna run through them and you can just at a high level just touch. So are some or all of my insurance proceeds taxable?
well, and generally, most of your proceeds are not going to be taxable, but there's some reporting that's required, specifically receipts for contents is tax-free, and contents part gets a little complicated, but it's all beneficial. But the first thing to know is that the proceeds receipt You don't have to worry about having a gain. If you have a loss because you don't have adequate insurance, you still get to deduct the loss, but generally I find that most people don't have a loss on contents.
All right. I'm just going to run through the rest of these because they're mostly questions we're going to talk through today. So how can you have had such a devastating loss and still have insurance proceeds be considered a gain? And as John said, you know, that's a depends. Are there tax exclusions available? We're going to talk about that. If you're underinsured or one or more categories, can you offset those losses on your return? Are litigation proceeds taxable? I know we've got a lot of folks from California with the wildfires, and they're involved in utility lawsuits. So we'll talk a bit about that. We'll talk about the tax considerations if you sell your lot without rebuilding. John, what about state laws and tax laws and property taxes?
Okay, I'm not sure exactly what you're talking about. I assume you mean in terms of your cost base, your tax assessed value.
Yeah.
Well, I don't know for Colorado specifically, but for California, basically, if you replace your house, you rebuild, and you basically keep the same kind of footprint, you basically just keep your old tax base. So if you bought a house in 1970 and you've got a very low tax base because of Prop 13, you'll be able to maintain that. Now, if you add square footage and things like that, that'll be adjustments. On the other hand, Val talked about Prop 19. So if you decide to sell the house and buy someplace else in California, you can move that property tax base from the old property to the new property, but you're going to need to have an appraisal, and usually the assessor will take care of that, of the old property just before the event. And if your new property is the same as or less than the old property in terms of value, then it's a straight line across. If the new property is more, let's say $100,000 more than the old property, well, you'll take the old property assessment and add $100,000 to it. That's the Cliff Notes version.
Right. And for Boulder County, for the Marshall fire, I would suggest you, because Corey, I don't think you've seen anything for right now. So I would look for guidance from the tax assessor as things move along. They're juggling so many things right now. I don't think that's on the radar. All right. And Corey, my apologies for jumping out of order there. I'll turn this over to you.
Yeah, why file an extension with the IRS? Interesting that one of my mentors about 30 years ago told me, always extend and never amend. So, and especially in this case, it's probably very important to file an extension, as this, there's 4 bullet points here that really kind of outline it, what the rules around disaster and tax regulations are very complex, and it's many provisions to help offset the potential tax implications. But it takes time to really gather and get a full extent of any of the potential outcomes. And then the disaster declarations actually can lag and do not always happen by the IRS filing deadlines. So again, it can take several years to know the full extent of the possible tax implications, and it's better for us to take the additional time that the IRS has provided in order to really figure out what is the best strategy around this for your situation.
I like the guidance of extend and not amend. Yes. So yeah,
Yes.
Take the time to learn the facts. Yes. All right. And then, timing matters. I think both CPAs can speak to, while it might be easy to ignore this right now, tax reporting is part of the recovery process. And so, you do want to file your reporting as you have time and do it in a timely manner, and make sure that you're following the guidance here. And so these are 2 IRS publications, one for the California 2021 wildfires and one for the Colorado Marshall fire and the straight line winds. both of those disasters were rolled into one. All right, and as Corey, I'll touch on this.
Sure.
again. Yeah,
And again, I think the theme here that we're trying to get across is, you know, there's no rush to claim a casualty loss deduction. Losses can be deducted in the year in which the loss occurs, and all claims for reimbursement are settled. For losses that occur due to federal disaster declaration, as you see in the DR, you can elect to take the loss on the original or amended return for the year preceding the year of the loss. And then in 2021 losses, we have until October 15, 2022 to figure it out, to elect if you'd like to claim the loss on your 2020 amended return or simply claim the loss on 2021 return. And again, just kind of taking our time, gathering information, and then deciding what is the most beneficial for you to do that.
and then how do you find copies of prior tax returns?
Yep, again here, there's 3 bullets here. You can start with your current CPA, your bookkeeper, or if you prepare to yourself on an online filing service, a lot of times you're able to go back to them and get copies of it. Or we can help you submit a Form 4506 to obtain copies directly from the IRS. The fees, again, they'll typically be waived for the counties located in the federal disaster declaration zone. It's a very simple form to file and usually able to get the returns in a reasonable period of time.
And there is a tip, a link to a tip sheet there from the IRS if anyone has any questions about that. And then I feel it's important to just state, you know, what the purpose of the tax rules are. So, you know, they're collecting the money for the operation of government. Everything you receive has a value, has a tax consequence unless it's specified in that tax code.
Yep.
Go ahead, John.
Yeah, I was just going to say, you know, at the very beginning of the tax code, it basically has a section that says just what Valerie said. You know, if you received $1, it's taxable unless someplace else in the next 9,000 pages, we have a different outcome. And when it comes to these situations, there's a different outcome. And the important thing to remember is that Congress told the IRS in these situations to think differently than they normally think. Their thinking has to be adjusted to helping the taxpayer save money and keep money in their pocket, not collect money, not take that money away from the taxpayer. So everything is kind of upside down in terms of the normal thinking. And sometimes I find that even tax practitioners say, wait a minute, you mean I can do that? Or this is they're not going to come after us for this. And, you know, it's a very different situation. And the IRS is actually geared to helping. Now, they may not have the people to be able to explain that to you, but the tax law itself is very much geared to being very liberally interpreted by the IRS for the benefit of the taxpayer in these situations. But the other side of that is you've got to follow the rules and do the proper reporting to take advantage of all that liberal concepts.
I think both of you would agree these rules, they look very simple until you start to apply them, correct?
Oh, yeah.
Oh, yes.
All right, so this first question is, do you have a casualty loss or an involuntary gain conversion? And so John, I'm going to read the slide out, so and then give you both a chance to respond to any points you want to make on this. So you start with your insurance, have the proceeds you've received or expect to receive. Do they exceed the cost basis of the home you lost? If they don't exceed the cost basis, you may have a casualty loss. If they do exceed the cost basis, you have an involuntary conversion gain. And I will be really frank, it sounds like a bunch of gobbledygook, what I just read. So can you illuminate on this a little?
Yeah, the most difficult situations that I find is where people have owned their homes for a long time. And so they have a very low purchase price, what they paid for it. Maybe they haven't done a lot of improvements to the house, so their cost basis is very low. But they've been good about keeping up with their insurance, and their insurance is will pay them possibly as much as they need to rebuild, but possibly again, even because they have owned the house for a long time, maybe they're not quite savvy on what they should be insured for. So they don't quite have enough money to rebuild, but because their proceeds are far in excess of what they paid for the house, they have invested in the house. From a tax point of view, they have a gain because basically you've sold your house to the insurance company. You get to keep the land. You didn't sell the land to the insurance company, but the thinking in terms of the way the tax law looks at it is conceptually you have what's called a disposition, and you sold the house or at least the ashes to the insurance company, and so now you have potentially a gain which can be deferred, which basically means as long as you do certain things, you don't have to pay taxes on that gain.
So basically the idea that, especially for so many people who are underinsured, just because you're underinsured doesn't mean necessarily you're going to have able to take that off and write that off on your taxes, right? Because these are the options. It's one or this.
Right.
And so our next slide is what do people need to know now? And so what we've got is consider requesting a filing extension before the deadline. We've already talked about that. Your deadline, because of the disaster, has already been extended to May 18th of 2022 for taxpayers in the affected areas. John, I know you can speak to this. File your return or extension timely and report what you know.
Yes, and probably don't try to claim a loss at this point because you don't know all the facts probably. But also keep in mind that when we say the May 18th, that's only for basically for the Marshall folks, the people with that have a 2017 or 18 or even 19 and 20. Those people are still have to file their returns by April 18th. It's just the most recent fires that happened in late December that they get an extra month.
All right, thank you for pointing that out, John. Yes, we do have a mixed audience today, so I want to make sure that everybody is aware of that. And then also on the slide, just the idea of documenting. You want to maintain records of all your insurance proceeds, cost expended related to the event, everything related to that property loss. And we always suggest keeping a journal as well.
Yeah, the journal is really important for a number of reasons, but yeah, I found that with my own personal experience back in 1994 to be invaluable to have that journal, because you're not going to remember things. This is all new. It's all very traumatic, and and you're dealing with people who are all experts. You're dealing with a claims adjuster who's handling 30, 40 different cases, and he's been doing it for years. He knows how to save the money, the insurance company money, and you want to keep those journals of all the conversations, and also that's also valuable in terms of later possibly for income tax purposes. So yes, journals are very important. So yeah, you want to document everything. Your every money, all the money you spend, whether it's on rehabilitating the property or buying a new property or even buying contents, replacement contents. And when I say replacement contents, it's just stuff that you bought for the house would go in the house. So that includes clothing, shoes, socks, linens, bedding, furniture, televisions, dishes, appliances, anything. You want to keep track of that stuff. That'll be very important.
Thank you. And Corey, not the insurance proceeds part, but those costs, that you expend related to like a remodel or a renovation of your home, it's that same process you would be documenting for your CPA anyway, right? That, capturing what you've done.
Yes, absolutely. Just keeping a log and And what we would suggest is create a folder and start aggregating all the receipts for that as well. And then one thing, just pointing out, file an extension. You don't have to wait until the due date. Just go ahead and file it. As soon as you determine that you are going to extend it, you don't have to wait till due date to file it.
Thank you for pointing that out. Yeah, because for a lot of people, just getting that off their mental plate is huge.
Mhm.
Stage 2, identify and document your insurance proceeds. I'm just going to read what's on the slide, and both of you can chime in. Document and continue to track what you receive in insurance proceeds to use in determining what insurance proceed decisions mean for income taxes. So you're going to track all your coverages, your dwelling, your contents, ALE, scheduled property, other structures, ordinance and law, extended coverage. If you purchase real property with your additional living expenses, that ALE, you want to track that expense and purchase as well, because it could lead to a taxable gain. Documentation, to go back to Corey's point about putting things in a folder and setting up that filing system of what you've received, that documentation can include settlement letters, copies of the checks. And again, we've got that sample accounting spreadsheet to help you track both your max limits and the insurance proceeds that you receive. Anything that either of you would like to add to what I've just read?
No, the one thing I do like is setting up a bank account specifically with the insurance proceeds and using that bank account for making these expenditures. That just makes it very clean. It's not commingled with anything else, and then reconciliation's a lot easier for everyone involved. So that's definitely something we would recommend.
Also, what that helps is that you're going to have a lot of money coming into that account that's over and above what your normal spending is, and sometimes it's very easy to dip into that money and spend it on other things, and then all of a sudden you find out you're short on having enough money to spend on the things that money was intended for. So yeah, that's another good reason for keeping it separate.
Yeah, great point. And my apologies to everyone. Somehow our slide deck shuffled. So we should have started with stage 1, documenting the cost basis for real property there. And Corey and John have both already mentioned some of that. But let me just recap what's on the slide. Your next step is to document and preserve for later in the folder of the file system. Corey mentioned that cost basis for your real property, your home. You need to determine what a reasonable good faith computation of what was your cost basis at the time of loss. You can look for how much you paid, looking at the tax records, ask your realtor, check Zillow or any of those realtor sites for the purchase price. If you have plans, you could get a bid on what was built at the time of construction minus code upgrades. And then you can depreciate construction costs back to the time of construction. That's a bit complicated. But if you're looking at getting a scope of loss and having negotiations with your insurer, you might already be there. Might be looking at that path anyway. And including those home improvements, the additions and enhancements that you've done. That can include landscaping, trees, other structures. It's not just remodeling. As Corey touched on earlier, it's the kind of thing you would have already been documenting hopefully for your CPA, when you were looking at improvements to the home that you had before. So hopefully you have some of that information captured. And so anything either of you would like to add to that?
Just on doing that kind of a methodology to try to reconstruct the cost basis, I've had to do that a couple of times, and I've had ability to do it, one, because the taxpayer actually had the set of plans the last time I did it, the taxpayer had a set of plans of what was built, got a hold of the contractor, was still available and was able to rebid based upon the current cost. And then we did some cleaning up of the numbers to take out, like you said, the code upgrades, et cetera. And then I went to the US Census Bureau and got statistical information from them to actually, quote, deflate the cost back to the 90s in one case. And then we made a further adjustment because we said, geez, that still seems a little high. And I think maybe the construction costs that they're using for today for this area is based upon inflated construction costs. So we actually deflated it again and a little bit, another percentage, few percentage points to get it back. And my point there is it the exact number that was spent to build that house? No, but it's a reasonable amount, and that's, you know, what we have to work with.
Right, and that makes, providing that good faith calculation.
Yeah.
Corey, question for you on this. So, because I know we've got a lot of people who had rental properties. And typically, if you've got a rental, you would have, as you've been doing home improvements and things like that, wouldn't you document that on your tax return, because you're kind of doing that offsetting? So conceivably, somebody could look at prior records and pull some of that documentation, right?
Yeah, your tax preparer, or if you prepared it yourself, again, there would be a list of all those improvements that you made. And then also, I just wanted to touch on home improvements. Again, you probably can go back to the contractor that might have done the addition, modification, or landscaping. They're usually pretty helpful in regards of going back and looking up and getting the support for the improvement that you had them do at your residence.
Thank you. Those are good points to make. All right, and then we're going to go from 2 to 1 to now we're in stage 3, documenting your recovery costs. So your goal is to capture all costs of rebuilding your home or purchasing a replacement home. Those could be things like permits, your architect, required testing, etc., and the cost of replacement of your lost personal property. So if you're rebuilding, you're going to want to document those contractor costs, permits, fees, architect costs, testing. If you're buying a replacement home, documenting the purchase price, the fees you're paying, any inspections and required fixes, things like that. For replacing contents, and John, correct me if I say this wrong, you get to count these contents as if these were paid for the real property replacement, which has the net effect of negating some, but not all, of the deferred gain from real property insurance proceeds. And I know that's very technical. So can you unpack that just a little bit?
Okay, well, first is that don't ask if this is logical, because it's not logical, but it's tax law. And that's the first thing to know. Second thing to know is this is a beneficial, this is one of those liberal things that were built into the tax code by Congress to be helpful to the taxpayer. So don't try to understand the logic. Just understand that in effect, if you spend 20% of your recovery process money on contents and 80% on real property, and you have a deferred gain, well, you're going to be able to, if you've documented it correctly, you're going to be able to take 20% of that deferred gain and allocate it to the contents. And because it's contents, things that are just wear out and, you know, disappear and get put to the curve over time, that 20% of that deferred gain will never get taxed, and that's a good thing. So it's really important to keep track of these costs, and because this is so like I say, somewhat illogical. A lot of accountants are not aware of this benefit. I talk to accountants all the time that are amazed that you can do this. So, but it's important to keep track of those costs and be able to document that.
Right.
Yeah.
And this is, I'm sorry, Corey, go ahead.
Oh, I was going to say, yeah, I guess one of the things that we would always emphasize, if you're not sure, log it, save the receipt. The worst thing is, you know what, that doesn't qualify, but without logging it and saving the receipt, then we don't even have an opportunity to reduce the deferred gain.
Wonderful, thank you. And I just wanted to make a point that no matter where you are in the process, this all applies to you, you know, and go back and if you found you haven't done some of these things, go back and gather that information so that when you do your filing, you have all the information you possibly can to help you with this.
I talked to people, well, somebody today, and a lot of people today are buying all of their stuff, so to speak, on Amazon, and you can actually get a record from Amazon of what you spent. So that's a good place to I'm not recommending that you buy all your stuff from Amazon. I'm just saying that they do keep apparently a fairly accurate record of all your purchases, which they'll then use to market to you.
Oh, good point. All right, we're going to jump into some important tax terms. You're going to hear me talk for a bit. So why does it matter how your disaster was designated? So the big thing is it impacts your cash position and your tax opportunities. Insurance proceeds and grants or gifts specifically designated for contents damaged or destroyed related to a primary residence, just to be very clear, primary residence are not subject to taxation if the disaster was federally declared. And that's that specific kind of federally declared disaster, a DR. And this is even when they cause a gain or a potential gain. Contents losses can be considered when calculating deductions for casualty losses. And remember, a casualty loss requires the federally declared disaster, the DR. You may be able to amend your prior year's tax return and claim a loss if you sustained a loss as the IRS defines it. But again, at this point, I don't know that you have the facts to do that. If your disaster did not get a DR, federally declared disaster, then the insurance proceeds you collect for contents and personal property are reportable and may or may not be taxable. And I'm just throwing this back to you, gentlemen. It seems like there's nothing definitive. The answer in all of this is like, it depends, right?
Well, the important thing on these disaster declarations, FEMA has basically, they've got 4, but mainly 3 levels of involvement in these situations. And 2 of them, emergency management declarations and fire management declarations, are often preludes to a disaster declaration, but a lot of times they do not get elevated past that designation. And without them getting elevated to a full major disaster declaration, we don't have access to the special rules in the tax code. So it's important to know that the difference between an EM designation and FM designation and the Holy Grail, the DR designation. So I want to make sure that you've got that, the Marshall Fire, for example, has been designated a major disaster. So that's not an issue here, but often I'll see even in a situation like where there's a major disaster, I'll see somebody put down their fire management designation number, and I correct that, but people don't always know the difference between the FM and the DR designation.
Right, and this is where the Stafford Act that guides FEMA trips the benefits. It's based on that designation. One of the other benefits of having the DR designation is that there's additional time allowed for replacing items and extended timelines for certain filings. And just for our audience, for our 2021 wildfire survivors, for the Marshall Fire, as John said, you do have a DR designation. I believe the Dixie Fire does. I do not believe Caldor or the Fawn Fire did in California in 2021. So again, you can go here on the website to the FEMA disaster declarations and see if you have a DR for your fire.
Or you can also go to the IRS website for the around the nation for the newsroom and click on the state, and it'll tell you which what the active disasters they recognize.
Right, and both links are on here. Thank you for catching that one. All right, so next question. Which payments may be taxable by the IRS? What we've got here says, for those impacted by a disaster loss, regardless of disaster declaration, taxable reimbursements will include unemployment compensation, some ALE proceeds if they're used to purchase an asset rather than pay for temporary living expenses. Payments for real estate are treated the same as if they are proceeds paid by the insurance company. And the 4th bullet, some insurance proceeds related to contents, also contents in a second home, even if it's a DR.
I guess I just realized that there's another thing that you got to be careful of. Often you've got a situation where there's a mortgage on the property, and so the insurance company proceeds don't go to the insured. And instead they go to the mortgage company, because the mortgage company is kind of holding them hostage to make sure that their mortgage is safe, is protected, and they will distribute them to the taxpayer as they rebuild. But from a record keeping point of view, you're charged with having received that money, even though it went to the mortgage company. So $100,000 check gets sent to the mortgage company, and at the end, maybe just at the end of 2021, that's a 2021 receipt, even though you didn't actually get access to that money until 2022.
Good point. All right, non-taxable payments and proceeds may include payments for additional living expenses to the extent they're being used to pay for additional living expenses. And this can include insurance proceeds and FEMA payments, payments from social welfare agencies, charitable organizations, and in-kind services like free meals, medical supplies, shelter, and then FEMA payments under authority of Code Section 139.
Which are basically grants.
Yes, yeah. So that's that. All right, we're going to stop and take a deep breath because that's a lot to unpack. And then we're going to jump into, unfortunately, cost basis. And so cost basis. How is cost basis calculated for IRS purposes? So John, the bullets we have say purchase cost or inherited cost is used, not market value. Certain upgrades and additions can add to the cost basis. And the integral nature rule for personal use real estate, that's where the land, the fences, the home are combined, can accelerate or be combined and added to your cost basis.
Yeah, so the important thing here is what you're paying, the value that you're paying on the assessor, the county on your assessed valuation is not your cost basis. It is what you paid for it, what your improvements are. There may be some adjustments because maybe you've got I've got a poor client that had a prior disaster, so they have a prior deferred gain. So that becomes an adjustment on the subsequent property. Well, I don't know. You want to add anything, Corey?
No, John, maybe can you touch on the integral nature rule?
Oh, sure. So for personal use real estate, the tax law says that you've only got one number for your cost basis. So it's the real property. So it includes the house, the landscaping, the land, the fences, everything that is attached to that property is one single number for cost basis. On the other hand, if it's rental property, you've got separate accounting based upon your depreciation schedule. And in the case of a loss, you still own the land, and the land is not included as part of your cost basis calculations under most circumstances. I say most circumstances because if you sell the land as part of your total recovery process, you may be able to include that land and the cost of the land as if they are part of the disaster. But for the personal use real estate, whether it's a second home or the primary home, it's just a single number, which means that if you end up with proceeds in excess of your cost basis, the cost basis of whatever's left, including especially the land, at that point is zero. So when you go to sell the land, you're selling it at a zero cost basis, and that means you really want to include those proceeds as part of your total proceeds from the transaction, from the event, and defer that gain.
Yeah, John, thanks. I mean, that's just very tricky area. So I appreciate you walking through that. I get tripped up on that myself. So thank you.
Well, I think that's a good point for everyone listening. It's complicated. And so You want whoever you're working with to do their homework and understand and get to understand this in a way that makes sure they're following all of those rules, because the application of those rules is not simple. All right, so here's the what I call the $6 million question. If I'm underinsured, do I automatically have a loss for tax purposes? And we've talked about this just briefly. And so our talking points on the slide were no, because you may actually have had a gain in the IRS's view if you paid less for your home than the amount of your dwelling claim payment. To be able to claim a casualty loss on your tax return, your fire would have to have the federal disaster declaration, DR. Bear in mind your insurance loss is calculated differently than your dwelling's cost basis to calculate that casualty loss. You may be subject to a gain if your insurance proceeds and payments are greater than the cost basis of your property. And then the caveat, of course, there are ways to offset or convert these gains. And so, John, I know you get this question all the time.
Yes.
How can I be underinsured and not have a loss?
Well, and not have a loss. Again, it usually happens when people have owned the house for a substantial number of years. Again, I'll go back to my own experience. I bought my house in 1976 for $100,000. When at the time of the earthquake, the house was worth $400,000 at least, and but it turned out that the rebuild cost of that house turned out to be in excess of $800,000. So one, I obviously wasn't going to rebuild on a house on a lot that was only property that was only worth 400,000, but I definitely was underinsured because my insurance was less than the $400,000. And forgetting the land aspect, just the reconstruction was just way undervalued, and that was just you kind of rely on other professionals, and sometimes you don't get the right answer. So that's I would like to touch on a situation where you do have a gain, and we haven't mentioned this. Am I premature, Valerie, talking about the $500,000 exclusion?
It's coming. Yeah, I would hold it. We'll get there.
Hold off. Okay, fine. Okay, I couldn't remember.
Yeah. So we're going to pop now into our question is, do you have an involuntary conversion gain or a casualty loss? And so we have a very simplified flow chart that shows you the path to a casualty loss for a primary residence. So you have your disaster event on the left, and you've got two paths. You have qualified federally declared disaster, or it's not a federally declared disaster. And for the qualified federally declared disaster, you can either have a casualty loss or an involuntary conversion gain. And I'm going to put in parentheses because John just alluded to it, less that primary resident exclusion. If it's not a federally declared disaster, your option would be leading you to an involuntary conversion gain, less the primary resident exclusion. And then, John, I'm going to go ahead and pop over to your form 4684 scenarios.
Yep. Okay. So this follows the methodology or the math, so to speak, in the IRS's federal form 4684 for computing a casualty loss. And we'll see, but don't think of this as 4 different columns on the same form. These are 4 separate scenarios that are just being demonstrated on one form for comparison purposes. So we've got 4 situations here. The first 3 situations, we have a cost basis of 176, and you can put as many zeros behind that as you want, trying to keep the numbers reasonable. So 176 for cost basis. And the next line is our insurance. So this is where it gets gets fun, so to speak. In first case, we've only got 30 units of insurance. And so with 30 units of insurance and 176 cost basis, that's a flag. We really need to find out, do we have a casualty loss? So we're going to go down that path, and we're going to look at the next critical thing here, which is the fair market value of the property before and after. And this is kind of a strange thought when you think about it, because the way the IRS looks at this, it's literally the fair market value a nanosecond apart. 1 second, you've got this beautiful house that's sitting there, and a second later, it's gone. And you have a pile of debris. And so you have if this was a house, and in this case, I'm saying that the value after was 0, but of course we might have land, but this might be, there are situations where people have leased land, they don't own the land, or it might be a mobile home park where you own the coach, but you lease the land. So in this case, I've got it in this instance that the value of the improvements were 130 before and 0 after. So the decrease in fair market value is 130. So the rule is that your casualty loss is the lesser of the decrease in value, 130, or the cost basis, 176. So we'd be limited to the 130, and then from that we deduct the proceeds, insurance proceeds of 30, and we have a casualty loss of 100. In the second case, the difference is that we have a fair market value before, we have proceeds. Instead of 30, we have 150 of proceeds. So in this case, our loss is still 130, is limited to the 130, but we have proceeds of 150, so they exceed our loss. So we have a zero loss. We don't have a gain. We have what I call a non-event. The third case still, let's see, I think I still got the third case. I've increased the, no, excuse me, I'm sorry. Third case, still $150, 150 of proceeds, but in this case, the value before was 300, and the value after was 120. So I've got a decrease in value of 180. So 180 is more than the 176. I'm limited to my cost basis of 176. I have proceeds of 150, and therefore my loss is the difference between 176 and 150 is 26. And in the last case, my proceeds are, in the last case, what I've done is I've said my cost basis, I've reduced from 176, I've only got 126 cost basis, still 150 proceeds. I have proceeds in excess of my cost basis. I don't have a gain. Now, if I were to fill out the form and stop right here, that $24,000 of gain would end up being taxable, and it'd be taxed as a capital gains. But this would be a situation where you would not use the form, and you never, if you do not have a actual casualty loss, you do not want to use the 4684. The IRS does not have any form for involuntary conversions. It took me about 6 months back in 1994 to come to that realization, kept hunting around for one. And then when I started working on these things, I realized the reason why they have no form is because they're too complicated to come up with a form. It would be a 5-page form if they were being comprehensive in terms of trying to come up with a form. But what gets reported does not necessarily take up 5 pages. In fact, it can be done on 1 page if it's done correctly.
Right. So to recap what you just gave with your scenarios here, when asked the question, do people have a casualty loss? The answer is probably not. It's very rare that this is established and documented. However, other provisions of the disaster tax code could be of assistance in reducing any potential tax burden, right? So it's actually good news, not bad.
Yeah.
if you find you don't have a casualty loss.
I've got, going back to the, starting with the 2017 fires, I've got 4 people that convinced me that they had casualty losses, got the appraisals, did everything, claimed the losses. And then in subsequent years, we find out, oh no, well, first of all, they're involved in a lawsuit, or they got additional proceeds that they didn't know that they were going to get at the time. It turns out all 3 out of the 4 turned into actual involuntary conversions. And it's not a pretty sight when you have to deal with that reversal of fortune, so to speak.
Well, and that feeds back into what Corey had mentioned earlier, is that you're taking the time to document your situation, and giving yourself that time and space to determine what it is. This slide is a personal casualty loss is the lesser of either the cost basis of the damaged or destroyed property, reduced by all insurance reimbursements, payments, and proceeds, or the decline in fair market value, using, as you said, John, that instant before and after the casualty, reduced by all the insurance reimbursements, payments, and proceeds.
Right, and those valuations before and after, per the IRS, need to be done by a qualified appraiser. And those appraisals have special requirements that the appraisers got to conform to, which I don't think we'll get into today.
No. And then just to recap, what about Form 4684? If you don't have a casualty loss, just to confirm, you don't need to file this form.
Not only you don't need to, you should not.
Right. But for people going back to talk to their tax preparer on this, while the Form 4684 is the only form, as you said, the IRS provides, it's so complicated, there's not a form for it, but there is publication 547 that explains if you have a gain, you have to provide the statement attached to the return with all those circumstances reported. And you said, I think there's like 15 items to be addressed.
Yeah, about 15 items. I saw one prepared by a tax preparer a couple of days ago, which he had all the information, but he kind of wrote a dissertation and in a narrative form, and it turned out to be about 4 pages long in the tax return, and it had a lot of information that really wasn't necessary. So you want to be very concise.
Right, and just recapping, as you both mentioned, this area is so complex that the IRS can't even provide a form for reporting it. And so, this is not the time to go it alone. Our next slide is disaster casualty loss reporting. This is an actual example, John, this set slide with, item 2, cost or other basis of the property, that example you had provided.
Yeah, and I mean, this is basically what we just went through in the summary form. I don't know, it's really necessary to spend time on it. I think we
No,
Yeah.
I don't keep moving. Yes.
Yeah.
This is what it looks like. Yes.
That's what it looks like.
All right. Sorry, it's got little arrows that I forgot to click. Sorry about that. So how to substantiate a casualty loss. So similar to what's required for insurance companies, you must be able to show the following: the type of loss, the date that it occurred, that the loss was a direct result of the casualty, proof you own the property, or for leased property, you were contractually liable for the damage, whether a claim for reimbursement exists for which there is a reasonable expectation for recovery, and then documented evidence to support the claimed loss. Anything to add to that?
No, I think we've said it several times different ways, so I think we're there.
All right. So I do have an example of what is not a casualty loss, because I know we do have some folks on who were partial loss. So my home was not destroyed by the fire, but is located in close proximity to an area destroyed. My realtor thinks the value of my home decreased $100,000 as a result of the nearby destruction. Do I have a casualty loss? And Gerald Shriver had given this answer: probably not, since the decrease in value is likely temporary until the surrounding neighborhood is rebuilt. The house is not physically damaged. However, if you could provide permanent buyer resistant that results in a loss in property value, you might have a casualty loss deduction.
Yeah, but without actual physical damage, it's really tough to get a casualty loss.
Thank you. All right, determining the amount of loss. So the options we have here, we've got appraisal method, cost of repairs method, and including, of course, those subsequent receipts for the repairs, safe harbor computations, the year to deduct, loss sustained or prior year, and just a note that the loss cannot exceed the cost basis, which you showed in that example on your scenarios.
I've used the cost of repairs method only twice. And it's a tough one because first of all, in order to use the cost of repair method, you actually have to repair the house. And you do not get the deduction until you've completed the repair process. So it's not like you can get that money from a tax refund for claiming the loss and use that to help rebuild. You've actually got to do the rebuilding first, and then you've got all the costs that you've spent, and then you've got to go through those costs and take out the things that are not costs that for things that were there in the first place. So you've got to take out those code upgrades. You got to take out that extra bedroom that you decided to add while you're rebuilding the house. It gets very complicated, very time consuming. And it does not give, most of the time, it does not give a better result than the appraisal method. The only thing is with the appraisal method is you got to get those two appraisals up front. But the times that the last time I used actually was in Colorado back in 2013. And by the time I was brought in, it just was impossible to get appraisals on the property because the property had been changed so much, and there's no way of determining what the property would have been looked like and worth at the time of prior to the fire.
Let's go to our next slide. What information is needed to report a casualty loss? So we've got our cost basis or other basis of each property, insurance or other reimbursement, fair market value of the property before, fair market value after. And then that note there, not necessarily zero if completely destroyed, since the land still remains. And again, just a reminder, if you had a casualty loss, that would be the only instance that you're completing Form 4684. And just what to know about reporting. Gain on unscheduled property. Gain is not taxable and no tax reporting disclosure necessary. Gain on scheduled property combined with real property costs and proceeds, not replaced. And if reimbursements for business property or personal residence are not received until the year following the disaster in a gain situation, and there is no intention to reinvest, you would report it in the year the reimbursement is received. And I know you've mentioned that a couple of times.
Yeah, I'd like to just jump in here for just a second on this concept of scheduled property, because this is the first time we're mentioning this. So scheduled property is basically an insurance concept. One insurance company calls it a personal articles policy writer. And it's basically stuff that you have insured specifically, like it might be a $10,000 ring or a $15,000 piece of art or a very expensive antique that you literally get a separate policy amount. You pay a separate premium for coverage on that amount, on that item. And those items are not treated as regular contents because you have all this specific information about that. So they are actually, the proceeds and the costs are added to the real property. It's a weird calculation, but the cost of that antique is added to the cost of your real property. The insurance proceeds from the insurance company for the antique are added to your proceeds for the house. And so you could end up in a weird situation where I had a client back in 2017 that they collected fully on their personal articles policy before the end of the year in 17. They didn't collect money on their house until 18. But because they collected all this money and it was in excess of their cost basis, they had a gain that started a clock that started that clock in the end of 2017. If they hadn't collected that money until 2018, they would have gotten an extra year in terms of the replacement period. So, but these policies are fairly rare. I mean, I think I've had 1% of my clients have had personal articles or scheduled property situations, but that they are different.
All right, thank you for that. And this is the little diagram from before. It's a qualified federally declared disaster, a DR with a casualty loss, just to recap on this. So you have the federally declared disaster, casualty loss, you file Form 4864. Involuntary conversion gain, which, correct me if I'm wrong, this is more likely the scenario most people are facing, right?
Mhm.
Okay, so our question is, do I have an involuntary conversion gain? And so our bullets, it's very possible, especially if your home was purchased many years ago and values have risen. You can have a gain even if you're underinsured. IRS regulations can provide help to offset or defer gains from involuntary conversions. And then there are ways you can reduce the taxable gain while following these regulations. So anything either of you'd like to add to that?
Should we bring in the 500,000 now or later?
Later.
It's
I think it's coming up yet.
Okay.
coming pretty soon, yeah.
Okay.
So I'm going to run through these slides quickly. This is the involuntary gain conversion. You have the qualified federally declared disaster. You have an involuntary conversion gain, less your primary residence exclusion that John was alluding to. You've got two paths here. You either anticipate rebuilding or replacing your home, which means you might be deferring your gain. If you are not rebuilding or replacing your home, the balance, it could be taxable and you'll be filing that on Schedule D. Anything you guys would like to add to that?
No.
Okay.
And keep going. For those of you who's federally, you did not have a federally declared disaster, DR, but you have an involuntary conversion gain, your path looks like this. Your disaster, involuntary conversion gain, less your primary resident exclusion. If you anticipate rebuilding or replacing your home, deferring that remaining gain, and the same if you're not rebuilding or replacing, it's the exact same path. You would, the balance would be taxable and filing Schedule D.
Yeah, just the two major differences between with a gain between a disaster and a non-disaster situation is that in the disaster situation, the proceeds you receive for contents are basically off the table, but in a non-disaster situation or non-primary residence situation, you have to deal with the personal property proceeds just like any other proceeds in terms of figuring out whether or not you have a gain or a loss. And on the primary residence piece, if it's a federally declared disaster, then you look and say, at what point did you realize a gain? At what point do your net proceeds exceed your cost basis and you now have a gain? You go to the end of that year. So for 2021 fire, you may not have collected enough money in 21 to have a gain, but let's say that you do in 22. Well, that becomes your gain realization year, and if it's a federally declared disaster, you have 4 years after the end of 22, so going out to 2026 to replace the property. If it was not a federally declared disaster, then you only have 2 years to replace the property.
And we've got a slide that'll lay that out for everybody. So don't go feeling like you have to write that down.
Okay.
So if you have a gain, can you defer it? And so I know, Corey, I'm going to get you on the next slide, but if you want to chime in here at any point, feel free. So that involuntary conversion gain may occur if those payments, reimbursements exceed the cost basis of the property. And for your personal primary residence, it might be possible to utilize an exclusion to offset the gain under sale. I'm so sorry for the cat, under IRC section 121. And it's possible to defer the gain if the reimbursements are reinvested in either rebuilding your home or you're requiring a replacement home. And as Sean mentioned, within 4 years, if it's a DR, federally declared disaster, or 2 years if it's not. And this runs from the end of the first year you have a gain, not from the date of the fire.
Correct.
And then Corey, I'm gonna pop this, we keep
You
talking.
know what? I'm gonna let John have it. He's doing a great job, and
Great dive in.
this is yours, John.
Okay. I'm sorry. Everybody should understand I have a vision impairment, so that's why Valerie's doing the reading for me. So what are we talking about here?
Oh, this is the 250,000.
Ah, okay. Finally got to the 121. So
Yep.
in normal non-disaster situations, when you sell your house, your primary residence, you get to exclude up to 250 for a single person or $500,000 for a married couple of gain. That just, it's an exclusion. It's just chop $500,000 of gain proceeds off the top. Now, because these are considered dispositions, these are considered sales in a sense, that $250,000, $500,000 exclusion applies. So we get to literally exclude these proceeds. So we could have a situation where our gain in, let's say, 2022 is $450,000, but we get to apply that $500,000 exclusion and we don't have a gain. So one of the benefits is that's not, 2022 is not the gain year. When we receive another $100,000 in 2023, that will become the gain year. Now, there are a couple of interesting adjustments that happen here, or things that we have to keep track of. One is that in order to use this exclusion, the home must have been destroyed. So a partial loss does not count. But most likely in a partial loss, you probably are not you're not getting proceeds that exceed your cost basis anyway, so it's not an issue. But the fact is, even if you've got a low cost basis, you will not be able to use the provision in a partial loss. The second is situation where, well, what if you have, the normal situation is in order to qualify for this benefit, you have to have owned the house for at least 2 years. You have to have lived in it at least 2 out of the last 5 years. And basically that's 730 days. And you have not used this provision for at least 2 years. Well, I've got a client who just moved into a house 4 months before the fire, his fire. And he's got a gain. Guess what? We can use it, but we have to prorate. So in his case, he only gets 4 months out of the 24 months. So he gets basically 4 out of 24 is 1/6. He gets the 1/6 of the $500,000 exclusion that he can apply. And again, because he only bought the house recently, that's probably more than what he'll need to defer to eliminate most of the gain anyway. But those are the two changes. One is that it doesn't matter that you use the provision 6 months before the fire. It just matters that you've lived. What is the time period that you've lived in the house? And I also said 730 days. So it's literally out. If we're talking about the last 5 years, we're looking at, is there a cumulative occupancy of that house as your primary residence of 730 days? I had a client, I've got a client that was living overseas on a work-related situation when the fire happened. He hadn't lived in his house for 3 years, and excuse me, for 3.5 years. So, but that year and a half that he had accumulated in the prior 5 years got him a year and a half's worth of the 2 year period of the exclusion. So that was a benefit that he was still able to take partial advantage of.
All right, John, I'm going to ask you to slow down a bit so our
I'm sorry.
interpreter can keep up with you.
I'm sorry,
You're good.
I get
Corey,
excited.
yes, and when we get excited, we talk fast. So Corey, this exclusion is a normal, it's how we typically would do this anyway, right? So
Correct.
from a CPA standpoint, this is familiar territory for most people, right?
Yep, yeah, it definitely is. But again, the importance here is being able to figure out what your cost basis is and coming up with that information. Your original cost plus improvements.
All right, and our next slide is actually an example John had provided that just walks you through what this conversion would look like. You know, with a principal resident purchase for 150,000, 25,000 in improvements, home was destroyed. So instead of rebuilding, this person is looking at purchasing a new home for $275,000 and retaining the lot. And
So in this case, he spent $25,000 less than the amount that he needed to spend. So that $25,000 is taxable in the year that he received those proceeds. And he ends up with a cost basis of the replacement house equal to the cost basis of the house that was destroyed by the time you flow through this, all of the numbers here.
all right,
John,
thank-
yeah, John, I have to say, your schedules are a beautiful thing, but definitely a numbers headache presentation.
Oh, I
Good for a CPA.
I talked to Valerie, do we really want to use this?
Yeah, no, it's I track it, but definitely
Yeah.
the other one in this is a lot of moving parts. And again, I think that's just trying to emphasize the fact that really work with a CPA in this area of expertise to get it right, because it can mean either getting proper documentation, deferral of a gain, or capturing your loss correctly.
Thank you. Yeah, and again, that just drives home the fact how complicated this is. So John, here's the timeline slide, how long you have to replace property to use the tax exclusions on involuntary gain conversion. So the deadline is 4 years for a primary personal residence. That's only if there's a DR designation.
Correct.
The deadline for all others is 2 years, but you did share that extensions may be available. They just have to be filed.
Yeah, there's an extension process. The IRS seems to be fairly liberal in terms of granting those extensions. I have the last 3 years now, I guess the end of 19, 20, and 21, I've requested about 30 or 40 extensions. I'm waiting anxiously to hear back from the IRS on the ones that I filed at the end of 2021. But like I said, the IRS is fairly liberal in that, but you got to go through the process, and there's a lot of documentation that goes into supplying that, and you got to have a reasonable reason. And while part of the reason might be emotional distress, just the trauma and trying to get your head together, that can't be the primary reason for the request. It's sort of a garnishment to the application, but there should be other reasons, like you're involved in a lawsuit that you don't know what the proceeds are ultimately going to be there, and how much you're going to have to spend to replace the property, or you're having trouble getting a contractor, or the county is not issuing permits because of COVID. The end of the ones that I did at the end of 20, every one of them had a COVID paragraph in it. So so far I haven't seen the IRS turn down a request, but again, you got to be reasonable, and you've got to be complete in your explanations.
And you must file it. You can't assume you're going to get it. You have to.
Or you actually, yeah, you have to file it. there's an interesting thing that happens here is that, if you're filing an extension to file your tax return, you have to file that extension under normal circumstances by April 15th. You can't file that extension on April 16th. It doesn't count. But in these cases, again, getting back to the liberal attitude of Congress in this, there's actually a provision that says, oh, if you miss that year-end deadline, well, if you have a reasonable reason, and it's a reasonable time period after that, well, you can still get that application approved, possibly. Now, in the past, I've always thought, well, okay, let's assume that we've got a reasonable reason. Somebody comes in and talks to me on, just say January 10th or something like that. God, we need to get an extension here. So we get it in by the 31st of January. I thought, well, that's a reasonable time, and we've got a reasonable reason, whatever. I actually had one last year where the client, new client, came into my office in July, and we filed the extension the end of July, and I got the extension approved the end of September. I was kind of amazed. I told the taxpayer I give it 1% chance of getting this extension, but we were able to get it. But again, that just demonstrates. I point that out just to demonstrate the liberal approach that the IRS has in dealing with taxpayers in these situations.
Got it. Thank you. So quick question. Can I buy multiple properties to offset an involuntary conversion gain? And so looking at buying multiple smaller properties. The guidance is there is no limit on the number of replacement properties to avoid an involuntary conversion gain. Must be similar or related. Any personal use real estate generally qualifies. Acquisition of replacement contents, not necessarily identical, also counts, but you must follow the replacement period time limits or, again, formally extend them. Anything to add?
Well, just the general rule in terms of what qualifies as replacement property, the rule is that it must be similar or related in service or use to the residence so converted or contents thereof. So the important thing is similar or related in service or use is basically a functional test. How did this function? The property that was destroyed functioned as a place where you lay your head down at night and sleep. You eat meals, you entertain, your family gatherings, etc. It's a residence, and it does not have to be the primary residence. It just has to be a personal residence. So you could actually acquire a vacation home plus a new primary residence, and in the contents portion at the end of that basically says that the purchase of the contents for purposes of deferring the gain gets treated the same as if you spent money on actual real property.
All right, thank you. Next one, if I sell my lot, will the proceeds be taxable? And so guidance we have here is the sale of the residual land can, in most cases, be treated the same as if it is proceeds received from insurance. It will likely be substantially all gain. And then the caveat, if the exclusion has not been fully used prior to the sale, it can be applied to the land sale, but only if the sale is closed within 2 years of the date of loss. You want to unpack that?
So the sale of land, again, we're talking about personal residence. Keep in mind that because we already are in a gain position, the cost basis of our remaining land is now zero for all intents and purposes. And so now the sale of that is part of the recovery process. So it's on a personal residence, it's easy enough to include that as part, to logically include that as part of additional proceeds. The IRS or the tax law, that section 121, $500,000 exclusion, has a provision in it that any sales such as this have to take place within 2 years of the initial transaction, and the initial transaction was the actual fire. So that becomes the benchmark that you're testing that 2 years from. So if you lost your house December 15th of 2021, well, if you sell the lot before December 15th of 2023, that's less than 2 years, then you could include that as part of your calculation for section 121. Regardless of whether or not it's part of your section 121 calculation, it's still part of your deferral process and can be deferred. Now, what gets a little tricky is the escrow company is going to issue you a 1099-S, and you're going to have to deal with that on the tax return to report it and yet tell the IRS, okay, yes, I'm reporting the proceeds on Schedule D as having been received, but oh, by the way, this is zero realization, and see the involuntary conversion statement attached to see where this is coming in as part of my involuntary conversion. If it's rental property, it's a little bit different. You basically have to come to a conclusion, demonstrate that the land as it exists after the fire is no longer of economic value to you for its original purpose. It just may not be viable in terms of your ability to rebuild that rental property on that property. You may not have enough insurance proceeds, et cetera, to do that adequately. And so, you sell the property, you sell the land, and you go out and you buy a replacement rental property someplace else.
So John, one wrinkle on if you sell your lot, so when people are looking at their debris removal, that is typically part of that other calculation, because you receive those insurance proceeds against it. And that would have been rolled into those other calculations, right? Not held.
Yeah. Okay. Yeah. This is another one of these little complications. So the receipt of debris removal proceeds are part of the total insurance proceeds that you have to deal with. And that's true even if, say, FEMA goes to your insurance company and says, oh, John lost his house in the fire. Oh, yeah. You're the insurance company? Yes, we are. Does he have coverage for debris removal? Oh, yeah, he's got $50,000 coverage. FEMA says, we'll take it. Okay. And then FEMA takes that $50,000 and then doesn't charge you for the cleanup. They just take whatever is available on your insurance policy. Well, even though you didn't receive that $50,000, you're charged with having received that $50,000. On the other side of that is that $50,000 becomes a replacement cost. So it goes back into the land cost of the property that was burned. So let's say that now you've got this $50,000 that you spent on the essentially on the debris removal, and now you sell that lot. Well, that $50,000 now gets netted against the sales proceeds, and you only report as additional proceeds the net sales proceeds from the sale of the lot, less that $50,000 for the debris removal. I apologize for the confusion I've just created. Again, it's complicated, and it needs to be unpacked by somebody who knows what they're doing.
No, I appreciate it. And we do have a slide on that later, but for a lot of people, this is a concern. So I wanted to make sure we talked about that. Next slide is on reporting an involuntary conversion deferred gain. So reporting is, and is should not be capitalized, required annually, detailing the overall and current status of the reimbursement process, as well as other data and information. So accuracy and completeness of this reporting is key to communicating with the IRS and state tax offices in order to meet all requirements. And as we mentioned earlier, there is no pre-printed form provided by the IRS. These reports are part of the regular income tax return and are included starting in the year of the loss and end upon the completion of the replacement process. So that's just kind of a recap of where we are.
It's an episodic, I call it an episodic reporting, because you're actually telling the IRS year by year your cumulative situation and also what you accomplished in that particular year in terms of proceeds you've received and money that you've spent on reinvestment. And I kind of I kind of think of it as a story that you're writing to the IRS in chapters, and each year's report is a chapter in that book.
Right, and going back to what I asked Corey earlier, it from that standpoint, it falls kind of like if you had a rental property, how you're reporting annually to do that, but obviously for a very different purpose here.
Mhm.
All right, so we're going to take a deep breath, and when we come back on, John and Corey and I will talk nice and slowly for our intro.
I'll try.
So Valerie, where is this picture?
I believe this is one of our Southern California beaches. I don't know which one though.
It's a great picture. It's very, very calming.
Yeah, it's definitely not the Florida White Beaches. I do know that. I lived there for a couple of years. All right, we're gonna get into the final stretch here, talking about other considerations. And so for this, we're just gonna touch at a high level on some of the common questions. And really just depends on what your circumstances are. Did you have a rental property, a second home? We've talked about those replacement properties, trust, sale, lot sale, a lawsuit settlement, divorce, death, change of use, business loss, taxes. All of these things are going to impact what's going on here. I am just sharing this. This is just a repeat of which payments may be taxable by the IRS. We've already discussed it. We're just bringing this up again so that you don't forget, because it kind of flows into what we've got here. And then conversely, we've got which payments are not considered taxable by the IRS. Again, we've talked about this earlier. This is just for your reference because it's important for you to know what is maybe taxable and what would not be taxable. And then speaking of taxable, tax treatment of funds for ALE or additional living expenses. In all cases, including a DR federally declared disaster, insurance proceeds for ALE and other funds received for temporary rent and living expenses are not taxable to the extent they are used towards actual temporary or additional living costs. And these are expenses incurred after the event, not part of the disaster itself. These are not part of your casualty loss calculations. However, if you have excess ALE insurance proceeds, those would be taxable in the year you're no longer incurring those additional living costs. Out-of-pocket payments for ALE that insurance did not cover are not deductible. However, and I'm going to pop to our next slide, and then we can talk about ALE in a little more detail. If you decide to purchase a temporary home or an RV, which is considered real property, with your ALE proceeds, this is not considered an additional living expense. This is the acquisition of a capital asset, a piece of real property, and it will result in those remaining ALE proceeds becoming taxable. So things to note here, the temporary residence may be treated as part of the replacement property. This will spread that deferred gain over more properties. If you reside in that temporary residence for at least 2 years and you sell it to move into the permanent home, you can apply your exclusion, eliminating allocated deferred gain. Once you move into the capital asset you purchase as a temporary residence, remember you're no longer incurring those temporary living costs since you're living in a capital asset. So again, whatever is left over becomes taxable at that point. John, I'm going to pose a question to you. What do I do if I did a lease purchase agreement or buy a temporary home through my business and lease it to myself? I know people are trying to figure out different solutions to manage this.
Yeah, I mean, when you bring up an interesting, because what's one, you're basically shifting the income to your corporation. So one, I don't know that it's of any value. You probably don't want to put real estate in a corporation anyway. So I would really caution people against even thinking about that. I have seen situations where an insurance company will tell people to buy a property, form an LLC and buy a property, and they will, and create a lease between themselves and the LLC. The LLC is ignored on the tax return, but the insurance company says, "Oh, okay, we'll reimburse you for that that lease payments that you've created." Those become that's just taxable income because you own the property. You're getting deductions for your property taxes, for your mortgage. It's just like any other owned property. It's not additional living costs. It's just living costs. And it's, but if you can get the insurance company to subsidize you, well, that's at least an offset that at least you've got some proceeds coming in there to help you with that expense. And I acknowledge the fact that you may be paying on a mortgage on the lot and also paying a mortgage on the temporary housing, but the IRS doesn't see that as additional living expense.
Thank you. So what about legal litigation proceeds? I know we talked about that a bit earlier. What I've got on the slide is depends on what the proceeds are for. The written terms of the settlement or disposition of the lawsuit are what determines whether the proceeds are taxable. Generally, non-physical injury claims that align with real property, ALE, and contents should be treated in the same manner as insurance reimbursements. So they could be considered taxable if they go into your calculations for loss gain. Emotional distress and personal loss of income are taxable, and this is on the gross amount before any legal fees. There may be a state deduction for legal fees, but there is no federal deduction starting in 2018. Compensation for medical care and bodily injury are not taxable. For rental property loss of income, you can deduct the legal fees as ordinary necessary business expense like mortgage interest. And just bearing in mind, it can take years for these actions to play out to a final outcome. Anything else you'd like to add, gentlemen?
Well,
No.
just that the one of the things that we're going through in California is the Pacific Gas and Electric settlement that is being, the funds are being distributed by the Fire Victims Trust, who is issuing determinations of what they're determining, the claims that they're paying, and basically how they are paying those, how they're determining those payments is the key in terms of how they get treated for tax purposes. And it's important for taxpayers to get copies of those determinations. Some attorneys are a little reticent in terms of giving those things out. And I've had conversations with several of them, and they're getting a little bit better about giving those back, giving those out to the taxpayers. But that's what the IRS is going to rely on in terms of how things are going to get treated. And the determination for what they call economic losses are mostly based upon the same categories that the taxpayer would have for their insurance for real property, contents, ALE, et cetera. And basically they get treated the same as if they were paid by the insurance company in the short answer. The other awards for zone of danger or annoyance and mental and emotional distress, they are, like you said, taxable. But of course, in these cases, people are not getting the full amount in the year, in the single year. People that receive big checks or significant checks, I'll say, not necessarily big, significant checks in 2021 represented about 30% of what their supposed determination is. And it's only that 30% for 2021 that needs to be dealt with. So this is something that they'll be dealing with for tax purposes for several years going into the future.
Corey, you're gonna input?
No, John touched on a couple points that I was going to make.
All right. Okay, are business loss related losses taxed differently than personal losses? And so our slide, the gain on involuntary conversion calculation is similar to personal property with the following differences. The land is not included unless the land is sold due to it no longer being economically viable to the owner. For complete destruction, no appraisals are needed. No exclusion on gain available. The deduction is not limited by 10% of AGI and $100, and I'm totally gonna punt on that. Only consider adjusted basis in computing gain or loss, not change in fair market value, as we mentioned earlier. And again, that loss must be substantiated. Very similar to individual losses that you have the inventory. As Corey said, you have your documentation and you've got all that. So Corey, anything to add here?
No, I think this captures everything that comes to mind.
Okay. All right.
Well, I would just add that the what qualifies as replacement property for business property is a separate, is a different rule, and it's property of a type held for productive use in a trade or business. So it sounds very strange, but basically what it basically says is, let's say that I had a card shop that burned down in a federally declared disaster, and I no longer want to sell cards. I want to, my favorite thing that I always want to do is I want to have a taco truck. I want to sell tacos on the corner. Well, that is a property of a type held for productive use in a trade or business, and that totally qualifies. It doesn't have to be another card shop. If it's not a federally declared disaster, then that rule does not apply. And if my card shop burns down, the only way I can defer that gain is by building another card shop. I can't decide, well, now I think I'll build a I don't know, a dress shop. That's a different type of business.
Got it. Our next slide is, and I think we've touched on a little bit of this, can you defer a gain for a business involuntary conversion? And so our notes say if the gain results from proceeds in excess of cost basis for your business, you treat the reimbursements as sale proceeds. You have 2 years after realizing a gain to reinvest in a property similar to or related in service or use in repairs, rebuilding the damaged destroyed property. And it ties back into what you were saying, John, about the federal disaster declaration matters here.
Right.
Okay, tax implications from losing a second home. If your home was a vacation home, a second home, there's no exclusion available. You have 2 years to replace beginning the calendar year when the total proceeds exceed that cost basis of the property. And again, going back to this, if you have good reasons, you can ask the IRS for an extension 1 year at a time. You're going to combine the land, the landscaping, the building improvements, the building itself. It's going to be all considered one integral unit, one number. And unlike with the primary residence, the contents proceeds for a second home are subject to regular recovery rules, meaning you have to determine that cost basis and document those insurance proceeds. And, John, Corey, if there's anything to add, say so. I know we're running.
Well, what I find most of the time, luckily I haven't had too many people have lost the second homes. But I've had a few, and generally what we find is that the cost basis of the contents equals or exceeds the insurance proceeds. So we don't have a loss, but we don't have to have a gain, and it just sort of nets out to zero.
Got it. All right. Tax implications from losing a rental property. So rentals are considered investment property. There's no loss of rental income because you just don't pay taxes on the rental income you didn't receive. If it's not insured, most likely you would have a casualty loss. If not, you're in a different situation. You want to have your rental properties depreciation schedule from those previous tax returns to use in the calculations like we discussed with Corey earlier. A lot of that you've already baked into your previous tax returns. So you've got that information. It helps you identify the items lost, and that landscaping, the building, all those details you have become the basis for determining that loss. And this loss is simply the adjusted basis of the property at the time of disaster. So you can potentially skip those before and after appraisals.
Right, but the odds are you're probably going to have a gain because if you've owned the property for any significant amount of period, because your depreciation, you've got a lower cost basis to start off with. You're not including land, and all those costs have been depreciated for several years, and now you're getting replacement costs from the insurance company. Well, most likely you've got a gain.
Thank you for pointing that out, John. Yes. All right, timber lumber losses. This is just a real quick issue for some people, so I wanted to touch on this. If your land was zoned timber production, the value of the trees for lumber most likely had increased. However, as you're finding out, your homeowner's insurance will not cover the timber loss. It's just not insured as part of your policy. So you need to determine the appraised value of the property overall, which includes the trees before and after the disaster. And you cannot include in your calculation for cost basis the cost to remove the trees post-fire.
And it doesn't include the land. And there are some interesting tax court cases that are out there that are very useful in terms of understanding how to claim a loss in these situations. Because you might have a situation where you've got maybe 40 acre plot that's 30% burned, but you still may be able to use the cost basis for the full 30 or 40 acres of trees, even though a good portion of them didn't burn down.
Right. And again, just going back to our point, this is complicated.
Yep.
What about taxes and partial loss? Since that, we touched on this a little before, since your primary residence itself was not destroyed, that exclusion is not available. If your insurance proceeds are reasonable, it may still be less than your cost basis, so you probably don't have an involuntary conversion gain. And so the question is, could you have a casualty loss? And it all depends, starting with your cost basis and your insurance proceeds. So we've got an example here. I don't think we need to read it. This just walks you through what it could look like. All right, and let's go. Debris removal, we've touched on. So I'll just read it again just to make sure we hit all the highlights on this. While insurance proceeds may be paid directly to FEMA if you're part of a government coordinated program, those debris removal payments will be reported as your claim proceeds. It also becomes money that you spent, a replacement cost. So with a lot sale, those net proceeds after commission will be taxable, and you can subtract the expenses you incurred off the net sale of the lot. They're treated as an investment in the lot. That sale of the lot may or may not be covered under 121 exclusion now. And then Corey, I think you can wrap us up really nicely here about how complicated this is. And so, do you want or need professional help? And Corey, I'll let you wrap it up. I think the answer is kind of obvious, but
yeah, sure. Again, as everyone can see, this is a very complicated area. And again, being patient. If you're not sure, log it, work with a professional in this area. And, failure to report disaster loss on a tax return could result in totally avoidable penalties and loss of valuable tax opportunities. And then just kind of reading the slide, it's difficult to correctly calculate and successfully claim a casualty loss. Reporting on an involuntary conversion is even more difficult. Changing rules, complexities often make it wise to seek advice from qualified, vetted experts. And again, this is probably true with a lot of tax work, and especially when it becomes a substantial event like this, and probably people's largest asset, how to properly report it with the IRS and make sure that you're not overpaying on taxes or not getting any deduction that's available.
thank you. And I put in the chat John's favorite quote: "Don't ask a podiatrist to perform a root canal." I think that's our point. So we take a deep breath. And this last part is just literally a little bit about UP to plug people in. So now that I've caught my breath, we'll get going. So I want you to stay informed, sign up. You know, you can have people, friends and neighbors, have them sign up here at uphelp.org, sign up. You can obviously, as we showed you earlier, you can look at the video and the copy of today's slide on the events page where you register, or you can send an email if you need to. Join us at our Survivor to Survivor forums. It's a great resource for how other individuals have walked through this process. You know, what we found is with our team up volunteers, no one else understands your challenges and emotions like another survivor. Those are the first and the third Tuesday of the month, and you can sign up here at events. And speaking of events, here's a where it is on our website. You just you're logging on to uphelp.org. You click here on events, and you'll see the upcoming events. And below at the bottom will be the previous events, where today will fall tomorrow. And because this is so tiny and difficult to read, we have another slide that actually lays it out with you. So for our Colorado 2021 Marshall Fire folks, we have a Q&A for you on March 2nd. We are dealing with underinsurance for all of our 2021 wildfire survivors. That'll be on March 9th. For our 2020 folks and our 17 and 18s and 19s as well. If you're interested, we're doing Collecting Every Dime on March 16th. And on March 20th, for the Marshall Fire folks, we're doing Navigating Your Contents Claim. For anyone who has seen that before, this is that intro one for them. This is the first time they'll be seeing it. It's not our in-depth intensive one. So just so you know, you're welcome to join, but it is intended for a first touch. Pointing out the Colorado Division of Insurance, they're able to assist you. This is the information to contact them. California Department of Insurance, CDIs, here's their information. And last but not least, we'd like to thank our donors and our funders, the Community Foundation of Boulder County, our CRC, and the Golden State Finance Authority that allow us to be able to provide this. And I want to thank both of our speakers today, John Trapani and Corey Parnell. Thank you so much. Karina, our interpreter. Anything, John and Corey, you'd like to share with people? I know everybody's probably got a headache at this point, but it's a lot of information, but I think it's very good information.
Just take a deep breath.
Yeah, and again, take time, document, gather information, and make sure you're working with a professional to kind of wade through this, and it'll be a much better process.
All right, well, thank you all. Good luck with this. Remember, first thing first, just document, as Corey said, keep track. Remember, you can file an extension, and just take your time. And as John said, take a deep breath. So thank you all. And I believe we can stop recording now, and we'll let everybody go. Have a good evening.
Bye-bye.
Bye.